Welcome back, everybody. My name is Nick Romey, and I'm the Chief Investment Officer of ETF Portfolio Partners. Now, if you've joined us in the past, you've probably been here with me to discuss quarterly performance updates. However, given recent stock market volatility, we're going to be discussing just that, what's going on in the market right now and what it means for investors. We're also going to be going over what ETF Portfolio Partners has been doing to make sure our clients' portfolios are protected from this downfall and they're aligned with their long-term goals. So let's get into it. Thursday and Friday last week, we saw some pretty historic things, right? We saw major indexes across the board lose almost double-digit values. The S&P 500, which tracks the 500 largest American companies, right, publicly traded, it was down 10.5% just in 2 days. The NASDAQ Composite Index, large cap technology companies follow this index. It was down 11.4%. And then the Dow Jones Industrial Average, those 30 stocks they're relatively famous just simply because the Dow has been around for so long. It was also down 9.3%. What we know at this moment is that last Thursday and Friday combined for the fifth largest two-day decline in stock market history. I can tell you right now, you never want to be a part of stock market history because it usually doesn't mean anything good. What we also know is that the NASDAQ Composite Index has officially entered a bear market. All that means is that it's down 20% from its all-time high. And what we also know is that the S&P 500 is on the brink of a bear market. And this is important because the S&P 500 is the relative gauge of the total United States stock market performance. And regimes are essentially broken up based on if the S&P 500 is in a bear market or a bull market along with recessionary phases. So it's important to understand that the S&P 500, or what a lot of people would refer to as the total US stock market, has not experienced a bear market yet. And as you can see here, we have Friday's closing values for the S&P, Dow Jones, and the NASDAQ Composite. You can see the high point, the highest level they ever reached, and then the percent off the high. So, right, again, the NASDAQ Composite, very much so in a bear market now, down 22.73% from its all-time high, with the S&P just barely holding on. What we also know is that volatility is likely to continue in the short term, right? Markets are currently trying to reprice themselves. And what we know about the market and what we talk to our clients about all the time is that the market is this mechanism that's always trying to find the future value of itself at some point in time. When it receives new information, it must immediately discount that information to come to a price that it determines to be a fair value. And that's done very rapidly. And that's what volatility is, right? It's the immediate price adjustments in the stock market. But how did we get here, right? Because as with any correction, there's never just one clear answer, right? Yes, you can say tariffs. Yes, you can say that the tariffs were handled poorly, in our opinion, but you cannot say the tariffs were the sole perpetrator of this stock market volatility and of this 10% decline on Thursday and Friday. Number one, let's look at the S&P 500 over the last 2 years, and that's what this chart shows. It's from 2023 to 2024. The S&P 500 rose dramatically, right? We saw a cumulative return of 55%. It's the first time the S&P 500 had back-to-back greater than 20% positive returns since 1997, I believe. It was the late 90s, I know for a fact. So again, we had a massive run-up in the stock market right before this. Number two, stock market concentration. This is something about 6 months ago everyone was really concerned about, right? We saw price to earnings ratios rise above their long-term historic average, actually quite a bit above that long-term historic average. And obviously today, as you can see, the PE ratios, right, that concentration is very much subdued, right? It's come down, and what you can also see, right, those mega cap technologies or the Mag 7, their forward earnings are now looking relatively undervalued. So something to account for, but definitely, right, the run up we had with the S&P 500 fueled by large cap companies, primarily large cap technology companies, we got to a point where essentially people knew we couldn't go much higher. And then finally, something that needs to continue to be talked about is the Federal Reserve has gone through one of the most aggressive rate hiking cycles in recent memory. They raised the short term interest rate level from roughly 0% to 5.25% in a matter of months, something that has not been seen before. And they needed to do this in order to combat inflation that came about during COVID. However, it was the aggressive level and the commitment by the Federal Reserve to raise rates as quickly as possible that fed into all of this. So, just to summarize, right, we saw very good stock returns, abnormal stock returns if you look historically from the past 2 years. You had very high concentration in large cap growth companies, right? That magnificent seven. How many times throughout the last year have we heard of issues in this large cap concentration? And then finally, extremely restrictive Federal Reserve policy brought on by prolonged inflationary issues. Inflation has still not come down to the Federal Reserve's target of 2%. They've maintained that they're going to fight inflation, and it's going to be their number one priority until they solve it. So, as with any stock market correction or quick sell off, right? The market is willing to accept all of these things, right? They're willing to accept above average returns. They're willing to accept concentration in several just companies that make up most of the stock market. They're even willing to accept restrictive Fed policy as long as the economy is doing well and the stock market's moving up. That was happening and it still is happening. However, the catalyst, right? You always need a catalyst for a market sell-off, and the catalyst for this sell-off was the Trump administration's announcement of the blanket tariffs, the reciprocal tariffs, and the targeted tariffs. That we saw the spike in volatility and the reversal of the stock market essentially. And even though we all knew these tariffs were coming, it was the magnitude and the severity of these tariffs that caught a lot of people off guard, and that caused selling, right? We always talk the market's a mechanism. It's trying to price itself in the future. Well, it just got a whole bunch of news that it wasn't expecting, and it very quickly repriced itself, right? That's exactly what we saw on Thursday and Friday. So even though we've had volatility, ETF Portfolio Partners has been making changes in the portfolios. We've been doing this over the last several months, right? One of the things we've been doing is adding to growth that part, right? The Nasdaq, the piece of the stock market that's actually been beaten down over the last several months now. We've been adding to it, right? Because as investors, when you look at a group of stocks, not talking individual, but just a large group of stocks, what we know is historically we can find their expected returns. And when something is down like the NASDAQ or large cap growth, getting in at a 10%, 15%, 20% discount to its long term average always makes sense in our opinion. Another area we've added to is small caps. Small caps have actually gone down the most out of any of the style and size categories. As such, we've increased our exposure to them in order to take advantage of this opportunity, essentially. And then finally, something we did is we've increased our international equity exposure and we've reduced our US equities exposure. We've talked about this throughout the last several years, how there might be a rotation from US equities into international equities. It looks like potentially we're seeing that rotation right now, and we wanted to better position our portfolios to take advantage of that rotation. So as you can see on the screen, before the rebalance, our style and size categories, and then after the rebalance, slight shifts, right? We're never going to go all in one category. We're never going to make huge bets. We're trying to tweak outside the edges in order to help protect the portfolio from drawdowns like we're seeing right now. And then also with our equity rebalance, we're very excited to announce the new addition of a fund, HDEF. I'm sure a lot of you have seen it in your portfolios already. HDEF is the X-Trackers International Large Cap Value Fund. This is going to hold primarily European stocks, financial companies, materials, industrials, things that are considered value in nature. They tend to pay a large dividend, but the most important thing, and the reason why we wanted to include HDEF, is that it has shown to have uncorrelated returns with US equities. As we always talk about in portfolio construction, implementation, and management, having pieces of your portfolio that move in different ways during different times is one of the key components of portfolio construction. And as investors are fleeing US equities, they're currently going and looking for other opportunities, a lot of which funds we've seen have been flowing into European large cap value companies that HDEF holds. So just to break down, HDEF is our new ETF, International Large Cap Value. You can see our exposures to international stocks and US or domestic stocks before the rebalance and after the rebalance. As you can see, we now hold relatively 15% in international equity. I can say this is the largest amount we've had in international equity over the last decade. So that can tell you, where we see things going over the next several months and years, right? We believe we are going to see a rotation. It's only due, right? The US has had such a strong run up in the last 20 years that adding to international at this moment where it's been beaten down so badly should add value to the portfolio. Looking at HDEF now from just a graphical view, this is over the last 3 months. This is right, those uncorrelated returns. VTI is the US stock market, that's purple, and HDEF is the new portfolio edition, that's blue. And as you can see, as the US markets have begun selling off, HDEF has actually risen as investors look to withdraw money from US capital markets and are in search of return elsewhere. And I wanted to discuss now the importance of asset allocation, right? Bonds have finally begun to show their value. Bonds have outperformed stocks over the first quarter of 2025. And what we know about bonds is while they're not flashy, they're not going to give those huge returns that we see in stocks. They are a safety component in a portfolio. They're uncorrelated with stocks as well, which is why we like them in the portfolio. And what we know is that during periods of risk, right, when investors are feeling nervous, what they tend to do is they tend to sell out of the stocks and they go and purchase bonds or fixed income. And what that does is it drives the price of bonds up. So if you're already allocated a portion of your portfolio to fixed income, you benefit from this, right? And that's what a lot of our investors saw over the first quarter and with the market volatility on Thursday and Friday. They saw their portfolios down a lot less than the total stock market due to this allocation of bonds, due to the fact that bonds are actually increasing at this moment. Again, graphical chart showing bonds outperforming stocks over the last 3 months, right? Bonds are that red line. They're up about 2.7%, where US stocks are down roughly 15%. So again, diversification matters, asset allocation matters. We've been telling investors for a long time now, do not give up on bonds, have bonds in your portfolio. They're an important component of your portfolio from a risk and return perspective. And now we're finally seeing that play out. And finally, again, asset allocation. What this chart shows is different equity ranges. I know a lot of you are familiar with our model portfolios, such as a 60-40. For example, as you can see, a 60-40 over the last month is down less than 6% compared to the US stock market, down over 10%. And 100% in bonds has actually had a positive return over this time sequence. So again, asset allocation is your friend. You never want to be too much in one thing. Even though our stock portfolio is down less than the total stock market, everything is still going to sell off and bleed during times of volatility. And so every component, like stocks, right? And so when you have bonds in the portfolio as well, it allows for you to reduce some of that portfolio risk, to reduce the brunt of the market correction. So if you have any questions on this, let us know. We're happy to talk. I'm sure Rich can talk your ear off for hours on the benefits of asset allocation. But again, having bonds in the portfolio makes sense. They're uncorrelated and move differently than stocks, which is what you want in a portfolio. And now, finally, I just want to add some perspective going forward, right? We've had a really tough go the last couple months with the stock market volatility we've seen. I do unfortunately believe we're going to continue to see short-term volatility, right? A lot of people are saying, well, the market's down 10%. We have to buy now, right? I want to add to the stock market. And I can say, right, usually when people are calling and they're asking to add to the stock market, that tends to be a negative sign for the stock market. Usually you have to hit that maximum pain level to actually find a bottom in the market. I don't believe we're there yet. I think we're very close, but without a doubt, stocks could continue to go down, especially given the nature of the Trump administration and their characteristics of announcing things relatively with zero notice. So just keep that in mind, right? We've gone down a lot. I know a lot of people want to add the stocks right now. I am all for it. I think it's a great idea. However, I just think you may want to wait a little bit longer and see how things play out, right? The market can always go down more. Do not get that, do not believe that it can't. However, what we do know, and I'm kind of flipping sides here, but historically, what we do know is that after the market's been down, there's a very good probability we're going to see above average returns moving forward. And that's what this chart shows. It's from Fama and French, two very well received economists in our field in finance. And what they put together is where the stock market ends up after a 10% market decline, 20% and a 30% market decline. And what you can see is cumulative averages over that 1, 3, and 5 year period are very elevated, right? And I think a lot of you know this as well. But just going forward, we're likely to expect above average market returns. And then again, what I want to say is timing the market, right? Never a good idea. This graph here, I love showing this to our clients. The cost of timing the market, and it shows the orange bars are the value of $10,000 invested in the S&P 500, and just missing out on 7 of the tests of the best 10 days in the market, right? That took place during a bear market. And that's something important to remember too, is that some of the best days on record come right after very volatile times. So selling out and going all cash or making a drastic decision is usually not a good idea for investors, right? You want to maintain a long-term investment strategy and time horizon, right? Your asset allocation has been defined based on your goals, based on that time horizon. So don't get in the way of your own portfolio strategy, right? Like let it work for you. And finally, right, stay diversified, which is what we do at ETF Portfolio Partners. It's so important, especially during times like this. You want all kinds of asset classes because they move in different ways, and that's what you want in a portfolio. And again, stick with your investment strategy. And finally, and probably the most important, is to block out the noise. We tell a lot of people this, but during times like this, like we're seeing with the stock market, this is the media's Super Bowl, right? This is their World Series because they know they're going to have the most eyes on them. On Monday, when the stock market opens, regardless of where it's at, there will be more people watching than there have been in a very long time. And that is going to cause a lot of people to create a lot of different theories or ideas about where we're headed next. Block it out, right? Do not let outside noise affect your internal investment strategy. Do not let the things you can't control determine what you're going to do with your portfolio, right? To wrap this up, I wanted to quote one of the most famous investors of all time, John Templeton. He is famous for saying, the most dangerous words in investing are, this time it's different. This time the stock market won't come back. This time the economy's done for good. Yet what we know is that the US stock market and the global economy is extremely resilient. This is just simply a chart showing some of the things that have affected the stock market over the last 70 years. However, what we know is that each of these times has been a tremendous opportunity to be invested. And so we don't see this as being any other reason to not be invested, right? We trust data. We trust 100 years of stock market return sequences. Don't trust someone who is simply telling you this time it's different because they're trying to get views on their show or have you read their article, right? Stick with an investment strategy, remain long term, and you will be a better investor for it. So with that, I want to thank you for your time. Please let me know if you have any questions. I know the volatility is hard right now. Just hang in there. Again, the long-term investor will always persevere. So with that, thank you.